Hey, Mark, thanks for joining us. Pretty volatile day today, isn't it?
Yeah, I mean, it was pretty volatilely negative, I guess. Pretty much down the whole day. I mean, everything was closing at the lows. What's interesting, I guess, to look at is we saw oil was down significantly today. It was down, it closed under 95, and it's been, up close to 100 over the last week or two. Gold was down again today. Essentially, everything was down in the markets, and some of it was on the concern of the ADP jobs report this morning, which came in significantly lower than people were expecting, and some of it was the manufacturing data came in below expected, and then also looking at going back to the ADP number, I think it just signaled that maybe Friday's the main jobs number is going to be less robust than people are expecting.
Well, and that's just a way of saying that we're not keeping up with the growth in the population. We say, oh, we added 100,000 jobs, and that sounds just, without context, like a big number, and you realize, what is it? It's almost 200,000 jobs you'd have to just to keep up with the number of people who join the workforce every month.
Right, and that's always been and people have different ranges, but yeah, somewhere in that 100 to 200,000 a month just keeps up with the growth of the labor force. Although what's been interesting recently is, we've seen the labor force continue to shrink month after month because people can't find jobs, they end up off unemployment, and then all of a sudden they're no longer counted as part of the labor force. But yes, the 150 is what I would call just average, right? It's not heating things up. It's not really, making things worse. But we seem to kind of be in that muddle along range that we've been in for a number of months, and really probably the last couple of years. Now,
let me ask you, and I know that two stories I find juxtaposing. The federal government found a way to make $163 million. I think it was the Bank of America settlement, Mark. Yet they just reported that they lost $700 million in Katrina aid. So it's like one step forward, 5 steps back in here.
Yeah. But they'll probably find a couple more banks that they can squeeze some more fines out of. So.
And really, these were the fines for doing what ostensibly the government told them to do, or gave them permission to do, because the government had ordered them to give out more mortgages, and they said, "Listen, we don't have the money for this." And they said, "All right, well, how about we let you sell these derivatives?" And now we're fining them for it. It's amazingly bipolar, isn't it?
It really is a tough situation the banks find themselves in, and nobody feels sorry for the banks, but they have the SEC right now on the one hand telling them, you need to have stronger balance sheets, you need to have better reserves, you need to have higher credit quality, and then just yesterday Obama was out saying we need to lend more to people with weak credit history, and hoping that would help stimulate the housing market again. And so
they all come back to Mama.
Yeah, right. I mean, it's different sides of the government are telling you two different things.
So what do you tell somebody when they come to you and say, "All right, Mark, dude, I'm 35, I'm 40, I need a 401k, even though I'm supposed to have a pension. I've seen the stories that say Virginia's pension fund has a $63 billion hole in it. Help me out. What should I be putting my stuff in for a 401k so I can at least just retire without having to worry about eating dry dog food?"
Right. Well, I think especially for people in their mid-30s that are still accumulating assets, I think the important thing is, and the way I approach this is, you have to think about a longer-term view, right? And we've obviously had some ups and downs and blips, and the way I approach things is trying to find stocks that seem attractive at the current price today, and then sell them when I think they're less attractive. So we've talked a lot about healthcare. That's been a big sector that I've been invested in recently. But it's less so about where the market's going to be in the next 3 months or 6 months. For somebody that's in that 35 to 40 range, it's more about setting up a good plan, putting together a strong portfolio of high-quality cash flow generating companies, and then buying them when the valuations look attractive.
Now, healthcare is certainly booming because the baby boomers are booming in there. But at some point, there's going to be that correction. The statistical anomaly, the size of Gen X is so much smaller than their parent generation for whatever reasons, folks. We can opine on this later. This is an investment segment. Will healthcare take a hit down the road in 10 years or 5 years because of the baby boomers? Let's put this gently, just not taking the Paul Krugman option off of the, will they take it? Will we see that recede then?
I think that is definitely a risk for down the road. But, I mean, there's still baby boomers that haven't retired yet, and there is a huge demographic group that's in their 60s or early 60s right now that's probably going to live another 20 years or more. So I don't think it is a near-term risk to the healthcare space. I mean, yes, at some point, 10 years or more out, maybe demand drops significantly, but in the near term, it feels like a good spot to be to me.
So I want to ask you something, just out of curiosity. We're on Marc Smith on the entitlementsdestroylives.com guest hotline. RedWaveInvestments.com is where you find him. My grandfather was a contract lawyer, and apparently at one point was paid in stocks for helping do a deal, I believe, between a manufacturer of military vehicles and some car company called American Motors. So when we were doing his estate back in the late 70s, my mother found all these stock certificates for American Motors Corporation, and because he had helped Jeep, get in with them or whatever, and she found them, and they're just sitting there. They're just sitting in a desk drawer, just doing nothing, but a real certificate. And then, of course, by 1984, we're worth some pretty good change again. But the world of the day trader, the crass cartoon image here, but Lenny Dykstra, somewhere in between Lenny Dykstra and my grandfather, where's the happy balance between somebody who just takes some stocks and stick it in their desk drawer and somebody who's constantly on the day trading, click, 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 constantly
right.
Up and down? Where is the happy medium for somebody?
Well, I think your point is very well stated that both of those extremes are not the answer for most people. I mean, the days of just being able to buy something and hold it for the next 20 years are long gone. If they even existed really before. But I think the way I think about portfolios is there's a handful of companies that I own that I've owned for a long time, and that I have no near-term intention of selling them. And unless something drastic changes in their prospects, I'm not selling them. And then other companies, I look and I see what I think is attractive today, and I might have a 6-month or 18-month time horizon that I'm willing to watch a thesis play out. And I think the key is just to be monitoring, right? And if you are watching your portfolio, you have somebody who's watching your portfolio and is thinking about the companies that you own, why you own them, and how bigger macro pictures are impacting them, then you end up in a situation where you don't succumb to this in and out trying to make a few bucks day trading, as well as completely forgetting about something and watching it go to zero because you haven't opened your account in 5